What if overnight your Naira suddenly gained strength and your dollars became less powerful? That's exactly what happened this week, and it could be the start of something bigger. That's the twist behind Nigeria's latest currency rebound. The Naira closed at N1,480 to the dollar, while foreign reserves surged to US dollar 43.05 billion, a level that hasn't been seen in months. In this 10-minute deep dive, we unpack why the Naira rally matters, what's fueling it, and whether the gains can last. Number 1, the rebound, what the numbers say. On September 27, 2025, the Naira strengthened to N1,480 to the dollar in the official foreign exchange market. At the same time, Nigeria's gross external reserves climbed to US dollar 43.05 billion as of September 11th. To put that in perspective, just 2 months earlier, in July, the reserve stood at about US dollar 40.51 billion. The current account balance for Q2 2025 posted a surplus of US dollar 5.28 billion, up from US dollar 2.85 billion in Q1. Meanwhile, in the parallel black market, the Naira also appreciated, trading between N1,490 and N1,495 per dollar. This dual movement, stronger Naira and rising reserves, is being heralded by analysts and policymakers as a sign of stabilization. But is it sustainable? Number 2, what's driving the rally? Several factors are being cited as the engines behind the Naira's comeback. A, higher foreign reserves, stronger buffer. When a country accumulates more foreign reserves, it has greater capacity to defend its currency against speculative attacks or shocks. The inflow from various sources, oil exports, diaspora remittances, external borrowing, strengthens the economy's external position. B, reforms that the Central Bank of Nigeria, CBN, under the leadership of Governor Olayemi Cardoso, the CBN has introduced several reforms targeting transparency, accountability, and better dollar access in the FX market. They're also promoting an electronic FX matching system to reduce bottlenecks and arbitrage distortions. By simplifying dollar inflows for international money transfer operators, IMTOs, encouraging diaspora remittances, and unifying FX rates, the CBN aims to bring greater order to a previously fragmented foreign exchange system. C, less speculation, more real demand. Analysts are noting that speculative pressure on the Naira has eased. With expectations of further stability, some speculative capital may have pulled back. At the same time, genuine demand for Naira by importers, investors, and firms seeking to settle obligations has increased. D, stronger oil earnings and export inflows. Nigeria's economy is sensitive to oil. Higher oil prices or increased production can translate into more dollars entering the system. Combined with better policies to harness export earnings and diaspora remittances, estimated at around $23 billion annually, these inflows help shore up the Naira. E, current account surplus. A surplus in the current account, when exports plus income from abroad exceed imports, reduces the pressure for external borrowing and currency depreciation. The Q2 surplus of US dollar 5.28 billion gives confidence that Nigeria's external sector is gaining strength. Number 3, what this means for Nigerians right now. Relief for importers and consumers. A stronger Naira means the cost of imported goods, electronics, machinery, some food items, could ease somewhat. Importers would need fewer Naira to purchase foreign inputs. Eased pressure on FX access. Businesses that rely on dollars for raw materials, spare parts, and capital goods might find it easier to source foreign exchange at better rates. Potential moderation in inflation. Currency depreciation often drives inflation via higher import costs. A more stable Naira could slow this inflationary channel, especially for goods heavily dependent on imports. Risk of overconfidence and reversal. Currency markets are fickle. A resurgence of oil price volatility, a drop in remittances, or poor fiscal discipline could erode gains quickly. Some analysts caution that sustaining the rally will demand strong macroeconomic management, export earnings, and competitiveness. While a stronger Naira helps importers and consumers, it may reduce the competitiveness of Nigeria's exports. Exporters may find their goods more expensive in foreign markets unless productivity or value addition compensates. Number 4, challenges and risks to the rally. Even with the current uplift, there are headwinds. Number 1, reliance on oil and limited diversification. Nigeria's economy remains heavily dependent on oil revenues. A sudden drop in oil prices or disruption in production could reverse the positive trend. Number 2, maintaining fiscal discipline. The federal and state governments must control deficits, manage borrowing, and avoid loose spending that could undermine confidence in the currency. Number 3, external shocks and global volatility. Global interest rate shifts, capital flight from emerging markets, or adverse external events could destabilize inflows. Number 4, monetary policy consistency. The CBN must avoid contradictions, for example, liquidity injections that erode inflation control or policy reversals that confuse markets. Number 5, export growth and non-oil performance. Scaling up non-oil exports and strengthening sectors like agriculture, manufacturing, and services are crucial to reducing dependence on oil. Number 6, what to watch going forward. Oil prices and production levels. Any shock here could impact foreign earnings quickly. FEI inflows and remittances. Consistent flow from diaspora and investors helps maintain reserve levels. CBN policy signals, especially on interest rates, FX reforms, and monetary tightening or loosening. Fiscal discipline measures, budgets, debt issuance, and government spending will be scrutinized. Export performance and diversification, growth outside oil reduces vulnerability, and market sentiment and speculative behavior. Sudden shifts in investor confidence can overwhelm fundamentals. Number 6, final thoughts. The Naira's rebound to N1,480 to the dollar and Nigeria's foreign reserves climbing to US $43.05 billion are encouraging signs in a landscape that has often seen turbulence. Their improvements in external buffers, the current account surplus, and policy reforms are all contributing to rising optimism. But this is not a moment for complacency. The path ahead is precarious, and sustaining this rally will demand discipline, consistent policies, and strong performance in non-oil sectors. The gains are tangible but fragile, and the next shock could reverse them as quickly as they arrived.
Thanks for watching. If you enjoyed this update and want to stay informed with fast, reliable news, don't forget to subscribe to Newsflash 360. Hit the notification bell so you never miss a story. Your next headline is just seconds away.